Hey folks, welcome to the Rain channel. Today we're talking mortgages. What's going on in the mortgage world? Of course, Tiff Macklem gives us another sucker punch last week and up the rates again. So today I'm joined by Rain's trusted partner and the founder of Streetwise Mortgages, Dahlia Barsoum. Dahlia, thank you so much for joining me.
Thank you, Patrick.
Now, we talked a little bit off air, if you will, about what the heck is going on in the mortgage world. I got a commercial mortgage coming due and September 1st. And, my rate sheet is, somewhere between 9 and 10.25%. I'm going, what the heck? What do we do with all of these things that are going on? You were sharing that on the residential side, people are really bumping up against the challenges of qualification. Let's unpack a little bit this for our listeners. Let's start by saying, what are you seeing in this mortgage world? What's your thought process, and how are you kind of guiding perhaps some of your clients in making decisions given the rate increases, the qualification challenges? Give me some insights into what you're seeing from your side of the desk.
Here's what we're seeing. We're seeing pain right now on the residential side. Clients who are on adjustable rate mortgages have experienced higher payments as the Bank of Canada continued to raise interest, obviously. Clients who are into coming into renewals, new rate environment, maybe more than double that what they have. So they're seeing their payment go up. You also got tougher qualifications overall because the stress test is still there. Believe it or not, despite all of this, the stress test is still here. We can argue forever about the benefit of the stress test in this rate environment, but obviously it's making things also more challenging. So we're seeing pressure on cash flow, household budgets, investor property cash flow. Even those who are on a variable rate with a fixed payment, there is heavy talk by the regulators right now to eventually figure out how to bring these payments in line, because we're seeing 80, 90-year amortizations on the books of some banks. So all of that is happening in the residential world, and it's obviously adding pressure on many clients. And what we're doing is we're telling clients, okay, where can we alleviate that pressure? And there are still ways. And that includes, again, looking holistically at things and seeing where some big payments could be eliminated and replaced with cheaper money, switching to interest only. We're talking, if you take a 9% interest only, compare it to 8% principal and interest, you can actually get some breathing room switching to an interest only, although the interest rate is higher, So looking at interest only options, reshoveling debts to clear the budget. That's all the options that we're looking at right now, and helping clients just figure out how we're going to write this, because this is not going to last forever. It's just about figuring out how do we ride this cycle. So a lot of the conversations are taking place around that topic right now.
Yeah, there's a lot to unpack there. And so I've got some thought processes around the conversation in terms of, when we consider that, first and foremost, we still believe strongly that real estate is an asset that investors have to own. We go through this right now, this pain, if you will, and discomfort of trying to figure out how to actually invest in real estate. And so where do I want to go? A couple things. First off, you talked about amortizations that are changing. The banks are also getting a lot of pressure put on them. Maybe give us a little bit of insights. OSFI is kind of reading the riot act of the banks by the sounds of it. They're not going to act quickly. They can't move that fast. But can you give us a little bit of background based on what OSFI is telling the banks and what it might mean to us? Then I want to get into where you're seeing investors' capital move to, but that's a different conversation. Let's start with OSFI.
So with variable rate mortgages that are offered through some banks, the payments have been staying fixed, but beneath the surface, as interest rates go up, less and less of that payment is going towards paying down interest. So in many cases, the clients are just paying interest only on these mortgages. And to keep the payments fixed, the amortizations have been shifting. And this is why we've been seeing the 70-year and 80-year AM. So OSFI is saying we're concerned about these mortgages being on the bank's books, and we need to mitigate that risk. So they're coming at it in two ways. They're saying, okay, banks, if you have these mortgages on the books, we need to see you increase your capital reserves, put some capital on the side because we are concerned. That's one way. And in some other cases, they're asking the banks to consider making changes to these payments so they can bring the amortization back online, in line. When OSFI asked the banks to put capital reserves on, additional capital reserves on the side, Patrick, essentially it's telling the bank, put it here, you have less pool of money to lend out. So that means that that bank is tightening their, their money supply to the market in a way. So they haven't finalized yet which path they're going to take, but there's a lot of talk about this topic right now.
Did they not do that already once in early 2023 or late 2022, where OSFI said, up your reserves 5% or 3% or 10%, whatever the number was? Did they not do that once earlier already, which was to say, you need to build your reserve and tighten up, or build your reserve, not tighten up, but build your reserve funds?
Yes. Yeah.
So this is the second time they're doing it.
Yes. Yeah.
Not a good sign.
No, there is writing on the wall that they're trying to tighten the money supply.
Yeah. Quantitative tightening after overreacting to the pandemic and flooding the market with cash. It's interesting that 3 years ago I remember having these conversations, quite specifically talking about that. Well, I always saw it as a mistake, but that's a different conversation. So let's go ahead. When we look at what's happening in the real estate market, ultimately we know supplies is an issue, will continue to be an issue. Anybody who's relying on the government to fix the supply problem is delusional. It's not going to happen, which means that rental market is going to continue to be very, very strong, given immigration, given the fact that now we have even more refugees coming into this country. It really is. I mean, we can get into the whole argument of what it's causing in terms of infrastructure beyond housing, given healthcare, et cetera. But for this conversation, if we stay focused on the fact that we need rental housing, which means for investors, good opportunities. But you're seeing some of the investment community go to a multifamily or go in a multifamily direction. Is that the case, or give me a little bit of info or insights into what's happening there?
So despite the tightening in the residential space, Patrick, we're still seeing investors buy properties and recognize the fact that there is opportunities right now. It's not like everybody's sitting on the sidelines doing nothing. This is a time to buy, especially in markets that will continue to have strong demand, and we have a supply problem, like you said. So we're still seeing momentum on that side. And my philosophy is always, if we can make the numbers work with residential money, that is still your good source of money, because commercial money is more expensive overall. There are higher fees, longer process. It's more complicated. But what we're starting to see is some investors tapping into the commercial money world because there is an option with CMHC that is actually cheaper than residential right now. The rates are at around 4.5% to 5%. Yeah. And you can get extended amortizations. Under the regular program, you're looking at up to a 40-year amortization. And under their new MLI Select program, you're looking at 50-year amortization. So I am definitely seeing more investors tap into that by buying 5 units or more, or by taking some residential properties and restructuring it as a commercial deal, so we can utilize that type of money right now.
So when you do that, I want to go back in my memory banks around some of the ways to do that is actually taking, a number of properties and putting them under the umbrella of a commercial mortgage. Is that correct?
Correct. Yes.
Now, did we run into the problem in doing that, Dahlia, of when renewals happen and when, certain mortgages are coming due? Because that can get a little bit complex in that as well. Is that the case?
Yeah, so with residential mortgages, you sign for the term. As long as you're making your payment, you never hear from anybody, and you get your renewal in the mail, and you pick a term, and that process continues. And
Yeah.
commercial, you're right. The renewal is not the same, and there is something that happens on an annual basis. It's more of an annual review. Where they
Mhm.
look at the performance of the asset, and they want to make sure that the numbers still work for the loan, that the property can still support the loan.
Mhm.
So there is that annual review, and then at the time of renewal, it's not just about sometimes signing that document. The lender may come and say, "We just want to make sure, we want to see the financials," or um, "We want to change our loan structure because we're no longer comfortable in this asset class." Like that's there is more to have a conversation about in commercial renewals
Yeah.
versus residential renewals.
Now, I know that you're such a strong proponent and do such a great job of supporting investors in terms of actually putting a plan together to actually look at the portfolio, break it down. Now, do you think now, given the interest rates, is there a case in terms of, is there a case for paying, let's say, a line of credit, and maybe you've got the cash and you're looking at getting another mortgage, and but you've got some cash? Does it sometimes help or make sense to actually, when you look at an ROI, if you've got a line of credit that you're now paying what, 7 or 8% on, 7, 8%, maybe even more, paying that off, that changes debt service ratios, then going for a mortgage? Is that, would that all work into a planning kind of thought process, Dahlia?
That's definitely something we look at, Patrick. In some clients' cases, it makes sense to pay down something to qualify for more. And in some other cases, it makes sense not to touch anything and to just, move on. So
Yeah.
part of our planning conversation is, where's the money going to come from? How are we going to make sure that you qualify? Where can you save? How can we improve cash flow given the current rate environment? All of that is part of the conversation that we typically have.
Now, when you're having conversations and you're looking at mortgages, and I know that you are pretty much across the country, there was a time where banks were favoring certain cities and certain provinces. Now, are you seeing a propensity for, and everything gets, decisions are all made at head office in Toronto, from a banking point of view, but are you seeing a propensity for banks to favor a province? Like right now, we see a lot of money and hear about a lot of money moving into Alberta, for example. Uh, are banks more likely to finance in Alberta, for example, or over a British Columbia or an Ontario, where prices are very elevated and cash flows are very tough to get? Is there any truth or thought process behind that that kind of resonates?
On the residential side, I wouldn't say that lenders favor location outside of the B lenders. The B lenders or alternative lenders are typically a lot more particular about
Mm.
location, and their location and geography changes all the time. The A lenders, which are the banks, are more about the property itself and the ability of the client to carry that mortgage. So I haven't seen preference for geography with the A lenders. On the commercial side, however, they're particular about the markets they lend in, especially, they don't like to lend in certain markets where the population is below 50,000, or they cut down how much they lend in these markets. So that type of conversation takes place with the commercial lenders more, I find, than on the residential side.
So when you're seeing, when you talk about commercial, are you including in that, let's say, multifamily residential, so, or mixed use? Are you seeing better lending opportunities in those scenarios where you're getting multifamily residential or mixed use residential, uh, and business or light industrial? Like, is there a place for investors to go where lending is more favorable?
Multifamily and mixed use, where the commercial space is below 30% of the total square footage, attracts uh, good money right now through CMHC, because even if these properties are in small markets, the lenders are still comfortable playing in that sandbox with CMHC's backing, especially under the MLI program, where they're trying to incentivize, landlords to create housing. um, they are a little bit more lenient, let me put it this way, to support that initiative. If the investor is buying something or renovating something under to enhance energy efficiencies or to keep some units affordable or to offer accessibility through the unit. So 5 units and above would qualify for that program. Mixed use with square footage below 30% would also benefit from that. Industrial and light commercial and other commercial categories cannot utilize the CMHC type of money.
It's interesting that whenever I have a conversation with you, Dahlia, I'm reminded of a couple things. And I'm such a believer in this, as you know, is that, you need to deal with investor focused mortgage brokers. And somebody like yourself who's professional, have been doing this a long time, understands it. And in a time when lending is more challenging, when finding even deals that make sense are more challenging, this is really the time where you have to work with somebody like yourself that can get this ball over the line, if you will, that lending ball over the line, over the finish line to get the financing, to get these deals done. And, so even in this conversation, I start to realize, back in another environment, it's easy. Everybody can seem to get a mortgage and money flows pretty freely. And things, to our point, aside from rates increasing, money is just tightening. The banks are going, okay, they're being told you need to use far more discretion in how you have less capital to lend out. You need to pay attention to it. So what would you want investors to know in this conversation? What would you add to what we've talked about here today, Dahlia, that you really want investors to understand and to know about what's going on in this environment?
I want investors to know that this is temporary. It's not going to last forever. I've been in the industry and I've seen things swing this way and swing this way. So what we're seeing right now, as much as it's painful, is temporary. We
I
need
think
to, yes.
I think that's such a great message and a great reminder. When we look at what's happening in the market today, we have to understand that this is not this is an influencer. This is a economic influencer. We talk about influencers all the time. Politics and interest rates are influencers, and yes, they can be really uncomfortable. And we look at even the influencer called COVID back at that time when things were shut down. It was an influencer, yet everybody thought the world was coming to an end, the sky was falling, and what happened was we went into a next level of economic growth and real estate growth. And when I look at what's happening today around interest rates, to your point, this is really, we have to know and really see that this is temporary. This can't and won't continue. Now, do we have a timeline? No. We both agree that there is no point in trying to second guess the Bank of Canada or our federal government these days. And quite frankly, it's a global issue. This is a challenge that many countries all countries are facing, and we're part of that, kind of world that is unfolding in front of us. But we still see Canada as a strong, strong country, in spite of what we might believe politically or what we see going on. But most importantly is we have a gap. There is a demand that needs to be filled on the rental side of it. Therein lies the opportunity for those who are willing to do the work and go through the process in the short term and kind of go with the pendulum, as you say, it's over to one extreme. It doesn't mean you shut down. It just means you have to be more strategic. That's my thought process. I know it's a little bit long-winded, but anything you want to add to that?
100%.
Mm-hmm. Well, listen, Dahlia, for those of you who are following along here, reach out to Dahlia. She is remarkable with her team and what they do. That's why she's a trusted partner of the Real Estate Investment Network. Encourage you to reach out. Don't fold your tent. Don't sit on the sidelines. Keep looking for those deals. Reach out, put a plan together with Dahlia and her team, and they will get you guided in a way that you'll have success. And Dahlia, as always, thanks for your wisdom and your experience and sharing your insights today.
Patrick, thank you for the opportunity to be here. You've asked me what else do I want to leave the audience with, and there are solutions. There are solutions despite the fact that things are tougher and you may think this is the sky's falling. There are solutions on the debt side. There are solutions on the income generating side,
Mm-hmm.
on the equity side. And you would not, sometimes we don't see all of the solutions. So sitting down and looking at things holistically and identifying pockets is the conversation that everybody could benefit from right now. And you can reach us at info@streetwisemortgages.com. My team and I are here to help you. We seen a lot and we know how we can help. So there is no stupid question. Second opinion, you're feeling the pressure or you want to grow, reach out. We're here for you.
Beautiful. Dahlia, thanks again.
Thank you.